Legg Mason, Chief Investment Officer, is talking with Tom Keene and Ken Prewitt. Let's listen in.
Look at the angst here in 401ks. Mine's done worse than Ken Prewitt's. Full disclosure on that. Does it take skill or luck to get a recovery in someone's 401k?
I mean, this is actually the crux of this whole issue, and this is not just for 401ks and individuals like you and me, but also major institutions. This is the issue of reversion to the mean, and the pattern that we've seen with investors is when things are going well, they tend to pour into markets, and when things are going poorly, they tend to run the other way as fast as they can, and that leaves huge amounts of money on the table. So, and it may even define what is the top and bottoms of markets. So this is a big issue where you could, I don't know if it's skill and luck, but the key is to try to buck that trend of reversion to the mean, to be constructive when others are fearful, and to be fearful when others are constructive.
You know, almost everybody would agree with that. You know, but it's basic principle. If nobody wants it, buy it. If everybody wants it, sell it to them. But nobody does it.
That's right. And Ken, to your point, you'd say, well, maybe mom and pop we can understand, but maybe these sophisticated institutions, people that do this all day and are trained to do this, it turns out when you study their behaviors, for example, there's a study of 3,400 plan sponsors. They hire the people that have done well, the money managers. They fire those that have done poorly. And of course, subsequent 24 months, the folks they fired are the people who do better than the folks that they hired. So it's a classic pattern that we see across the spectrum from the least sophisticated to the most sophisticated investors.
So where are we right now? In other words, what do I do if I'm trying to rebuild my 401k?
You know, these are things, you know, forecasting is very difficult to do for anybody. But when I step back, I say it's very humble arithmetic. When I look at equities, for example, versus fixed income, long-term returns on equities, as we know, are basically a dividend yield plus some sort of normalized growth rate, and then some change in the multiple. Jack Bogle calls it the speculative element. So where are we today? Roughly, I guess, 2% on the S&P 500 yield. Is that roughly right? Mm-hmm. We've got about a 6 or 7% long-term earnings growth rate. I don't think that's going to be perturbed. And we've got a multiple today, if you go out to 2010 or 2011 earnings, that I think is relatively attractive. So we've got, I think, to me, 3 to 5 year prospects for equities.
The 10-year return on the Dow and the Bloomberg is 1.62% per year.
Right.
Which is, you know, you and I looking at an Ibbotson chart 15 years ago, we said, well, that would never happen. Yeah, well, do you just blindly load the boat on equities if you've got a 401k?
So here's the thing, Tom. I mean, in 1999, had we been having this discussion, we would have seen a high double-digit return, right. And we would have said, is that something we would have ever guessed? And the answer is, again, it's a part of the distribution, but a rare one. And now we're at the very bottom of that. And again, your best guess when you're at extremes. Yeah,
but as somebody said the other day, and I think of one of our baseball experts here at Bloomberg Surveillance, Melinda Masucci, and you know, the Baltimore Orioles have never reverted to the mean.
Well, I think markets have much more of a sense of reversion to the mean. Well, there are different issues there with money and all that, but there's a different issue with reversion to mean because of markets, because it's basically you have locked-in long-term trends with basically growth of GDP and basically growth of earnings. Now, the one thing I hear too, people come back and say, well, maybe the multiple will go back down to single digit. We have, as you just pointed, a 3% or less 10-year.
Yeah.
The normalized, if you just assume a 5% equity risk premium, that's an 8% cost of equity. A baseline commodity PE multiple is 12.5, which is basically where we are on 2011 numbers. So the market, and by the way, return on capital for corporations are at all-time highs. You're seeing, as you guys are pointing out, the numbers are looking pretty good. The cash build is ridiculous. Mm-hmm. And so, you know, I just think it's humble arithmetic. You take out that 3 to 5 year point of view because of the poor performance and the math. It seems to make some sense.
Well, Betty Lou, thank you for stopping by today with Bloomberg Television.